Using a stop loss order in stock trading is pretty essential, but if you do it wrong, it will dramatically hurt your performance. In this video, I'm going to explain how to do it right. So, what is a stop loss order? Well, the basic idea is that you're limiting the size of your loss with an automatic order to sell if the stock falls to a certain price point. So you buy the stock and then soon after you say, if it falls to X price, I'm going to automatically sell. And it's an order that you actually place with your broker called a stop loss order. Now, most people will use a percentage stop or a certain dollar loss if they don't want to lose more than $1,000. If the stock falls $1,000 in total value, then at that price, they will automatically have the exit done by the brokerage. Here's the problem with that method. It doesn't account for the volatility of the stock. You know, Microsoft is much less volatile than a biotech stock. And so to use an arbitrary number like a 10% drop in price, or if it falls and I'm down $500, that doesn't really consider what the volatility of the stock is. You know, for Microsoft to move down 10%, that's a big move. For a penny stock to move down 10%, well, that could happen in 8 minutes. And so what you have to do is understand the message of the market and how the chart tells you where psychological barriers are. I'm going to draw a picture for this in just a moment. But what we're looking for is the point where the buyers take control from the sellers, the price level where the buyers were strong. And the idea is that if the stock falls down below that price level, there's something wrong. So as I said, we're going to draw a picture to explain this better. So I want everyone to think about the stock market as a war between buyers and sellers. So if the buyers are winning the war, price is going up. If sellers are winning the war, price is going down. Buyers are winning, sellers are winning, buyers are winning. What's important is to look at what we call inflection points. These are the points where the sellers stop winning and the buyers take over control. So we can say that the buyers took control at that level or at that level. So that is an area of support. It's where the buyers took control back from the sellers. Now, why does that happen at that price level? Well, price fell to a point where the buyers found it attractive to buy that stock, and the sellers were no longer that motivated to push the stock down anymore. So that price level represents an opinion from the market. So when you look at a stock chart, you always want to look for the inflection point before your entry signal. So if we go back to drawing a picture, let's say we had a stock building an ascending triangle pattern, which is a good buy signal pattern. You've got rising bottoms, which are an indication of optimism. Every time the sellers were winning, price is going down, but at each of these floors, price stopped going down and started going up. And ultimately, you got a breakout from the ascending triangle pattern, which is a good buy signal. Any technical analysis book will tell you breakouts from ascending triangles are good buy signals. Well, what you want to do is look at the last inflection point before the buy signal. That is the price level where the buyers took control. So in this example, it's going to be here. And if you wanted to be a little more lenient, perhaps down there. So that is where you want to put your stop. However, the market always needs a little bit of wiggle room because, well, certainly with less liquid, less actively traded stocks, there can be little drops below that floor price and then it bounces right back. So I always like to look for the last inflection point and then go a little bit below that to give it that little bit of extra room. So if we look at an actual stock chart, let's jump into the Stockscores website. Here I've got a chart of Vermilion Energy. Now this is a stock that I picked right back here. It had another decent buy signal there. There was a few buy signals. This is a 3-year weekly chart. So this is a longer term trade setup. Well, let's use this point as a buy point. All right, at around $16, $16.50 when it broke out to a 3-month high from a rising bottom. So there was optimism. Just like here, there was optimism. It broke out through resistance right there. But we're going to use this more recent one just because it's a little bit easier to see. Now I'm going to zoom in on this. So we just look at the last 1 year. And we're going to say, okay, our buy point is there. Now, where should our stop be? Well, the last inflection point is right there. And we're going to go a little bit below that. So that's just for the sake of round numbers. Let's call that $11. And we're buying at $16.50. So the difference between those two prices is $5.50. This is where you use the difference between your entry price and your stop loss price to drive your position size. If you buy 100 shares of this stock at $16.50 and your stop is at $11, 100 shares times $5.50 per share in risk means your total risk is $550. And if you didn't want to lose more than $1,100, you'd buy 200 shares. If you only wanted to lose, $275, $300, then your position size would be 50 shares. So you work in that direction. Most people say, how much can I afford to buy? They'll buy whatever they can afford, not really thinking about what that means for how much they're risking. And then let's say they buy 1,000 shares because they have that much capital in their account. They buy 1,000 shares at $16.50, it's $16,500. They will say, okay, I only want to lose $500. Well, that means that the stock only has to fall just a little bit before it hits their stop. Now, here's a basic rule that you always need to keep in mind. The wider your stop loss, okay, the farther your stop loss is from your entry price, the higher the probability that the trade will work. But of course, also, it means that your potential loss on a percentage basis is also higher. So you have to balance having the stop at a price that makes sense, but also at a price where your upside potential is good enough for the risk that you are taking. So in the case of Vermilion, VET, we're buying here, our stop is there, and as it goes up, we are earning some multiple of risk, which we call our risk-reward ratio. Now, all of these concepts are things that I will be covering in some of the webinars that are coming up in this coming week. You can go to the Stockscores website and check those out. Just go to the upcoming events area on the Stockscores.com website. They're free. I'm going to go into these concepts in a lot more detail. We'll spend about an hour in each of the webinars. One will be focused on investing, one will be focused on day trading, and one will be focused on just how to read chart patterns so that you can do this yourself. All right, so we're not quite done yet. I want to show you how you can take this same concept and apply it to day trading. This is a long-term trade. We're trading off of the weekly chart. In this case, the hold period has been, 3 or 4 months, and the position size has gone from $16.50 to $28. So it's a nice, solid return as that stock was trending higher. Well, let's take a look at a stock that it was a good day trade today, the day that I'm doing this video. This is CRXT. And if you've watched my videos before, you'll know that I always focus on stocks that are behaving abnormally. And this stock was doing that. It also had a break from a good predictive pattern right here when it broke out of one of those little ascending triangle patterns that I just spoke about. Now, this is a 1-day, 1-minute chart. So much faster. You have to really watch these things closely. And we've got tools and algorithms at Stockscores that follow these things in real time so that we can catch them as close to the breakout as possible, usually within a few seconds. Okay, so CRXT breaks out right there. Our entry price is at about $2.60. Now I want you to look at this chart and where would you put the stop? Don't think about percentage drop. Think about where did the market turn direction? Where did the buyers take control? Well, we do that at inflection points. So if we're going to draw on this chart again, our buy point is there, and the floor, the most recent floor is right there, and then the wider floor is there. Which one you use depends upon how aggressive you want to be. Because this breakout was very strong, I would go with this one, but again, go a little bit below, a little bit of wiggle room. So that means your stop is going to be at about $2.30 and your entry at $2.60. That leaves your risk per share at about 30 cents. You buy 1,000 shares, your risk is $300. You buy 10,000 shares, your risk is $3,000. How many shares you buy depends upon your tolerance for risk. It's absolutely essential to not take more risk than you can tolerate, because if you do, then you won't take the loss when the market tells you to. These trades don't always work. If this stock fell down below that $2.30 mark, you got to get out and move on. But what happens is people take a position that's too big, they're staring at a $3,000 loss, they can't handle it emotionally, and so they hang on. Or worse yet, they average down and buy more. If you do that, you'll be out of business in no time. It's absolutely essential when trading to manage risk effectively, and we manage risk by using stops at the right price. I hope you've enjoyed this. If so, please click on that like button, leave a comment, tell me where you would put the stop on this stock or on Vermilion or any other trade that you've been doing. I'd love to hear about it. Hope you've enjoyed it. Subscribe to the channel, leave a comment, and most importantly, trade well.